What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be going over in this video is a brief look into what we have going on next week. We're going to take a look at the Ortex numbers, the utilization in the short interest, and more specifically, the option chain to see where those key levels are, where we could see those institutions start to hedge the options to provide more buying volume or even selling volume throughout next week. In addition to this, we also have a very interesting situation developing with Citadel and Melvin Capital. Citadel has recently withdrawn about $500 million from Melvin Capital. That is not a good sign for Citadel or Melvin at the current time. So we're going to go over exactly why they're making these moves and what the potential implications could be. Now, we're also receiving some more updates on this September 1st margin call date. So we have another basically notice from the FICC, the Fixed Income Clearing Corporation, and this is some really important info that I really want you guys to understand. We are seeing this liquidity bleed start to really take effect, and it just makes me more bullish for what we have going on in the near future. And the last thing that we're going to touch on is the fact that the hedge funds in general have been underperforming this year as a whole. Now, that just goes into what we've been seeing with the over leveraging and the liquidity bleed out as well. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button. So when we're taking a look at the chart here, AMC closed at 34.41 on Friday. After hours didn't do a whole lot. But what I want to show you guys is what we did over the last week. So we started the week at around $33.90. We closed the week at 34.41. That is a green week in the books, and that just shows us that we are winning. Anytime that we can get a green week, even a little green week like we see for this week, it's just a good sign for what we have going forward. So taking a look at the Ortex numbers, we have the utilization at 89.02, which I am expecting to continue to go up to get us to those potential forced share recall levels. We have the short interest right here at 17.85%, still incredibly high. Shares on loan, 104 million, free float on loan, 20%, and the estimated short interest again over here, right around what we were seeing as Ortex's estimates throughout the day. Now, coming over to Stonko Tracker to take a look at what we have in terms of options going into next week. At the current time, we already have 14,778 calls in the money and 14,584 puts. That's pretty even. So going into this week, I wouldn't really expect to see a net sell or a net buy off the board for hedging these types of options. And again, since this is the week after the monthly options expiration date, I would expect to see a lot lower amount of open interest and a lot lower amount of volume. So when we come over to the actual options chain over here for AMC, when we take a look at this going into the next week, there's nothing really that's jumping out at me right now. We have these $40 strikes right here with about 14,249 open interest. And other than that, I would just expect to see this option chain in terms of the open interest and volume repopulate throughout the week so we can get a better understanding of where we could be potentially heading in terms of those volatile price levels. Now let's get into the Citadel and Melvin Capital situation very briefly. So when we come over here, Ken Griffin's Citadel LLC and Citadel Partners are planning to redeem roughly $500 million of the $2 billion that they put into Melvin Capital Management after Melvin got slammed by bad short bets on GameStop and other soaring stocks, said people familiar with the matter. Now, when we come down a little bit further, we can see that Melvin remains down 43% for the year through July. Now, Melvin Capital is not the only hedge fund that is taking significant losses to a lot of these bad bets in the market. So here's kind of what this breaks down to. It is not good if you are a hedge fund to have capital pulled. The capital is kind of like your ammo to basically maneuver around the market and generate returns. If Citadel, one of the largest players in the market, is no longer backing you or pulling money out of your fund, that is a very bad sign. And I would not be surprised if you saw more money running to the door away from Melvin, especially after the terrible year that they have had. Now, I know there's been a lot of rumors circulating around that Citadel is trying to basically basically draw up cash and dump it into the Cayman Islands. I think that is more speculation at this point because I have not taken the time to look into it. But the fact that we are seeing Citadel basically take $500 million out of Melvin is not a good sign for them going forward. Now, taking a look at who is actually shorting AMC. So shout out to these individuals right over here. Caleb Shaw on Twitter. I've seen this screenshot a couple of times, and what it really tells us is that Citadel is not the top fund that is shorting AMC. But again, I would not say that these numbers are entirely accurate because they are taken from Fintel. Now, Fintel is reporting these from 13F filings, and I've shown you guys this many times in the past, but if you look at the SEC's FAQ, frequently asked questions revolving around these 13Fs, they're actually asked not to report these short positions. So let's get into this collateral crisis situation, this margin call situation that we have coming up that is making me so bullish. So what we need to cover first is this notice right here. So this is from the FICC, the Fixed Income Clearing Corporation, and it has to do with the GCF repo service eligible securities update. It has come to the attention of Fixed Income Clearing Corporation management that on occasion, netting members that are in GCF net funds borrower positions in the GCF repo service are satisfying their collateral allocation obligations to FICC on GCF repo transactions with expiring securities and or trust receipts. So pursuant to this rule, here are the securities that they are no longer actually allowing to be posted as collateral. We're going to break this down extremely simply a little bit later, but just follow along for now. So U.S. securities 1 business day prior to maturity. That sounds a lot like these reverse repos that we have been seeing spiking over the last couple of months. Eligible securities other than U.S. Treasury securities 4 calendar days prior to maturity, any trust receipt issued by a government securities enterprise. So the other thing that we have to think about is this is taking in effect on September 1st right here. We can see effective September 1st. What else is taking effect on September 1st? This right here, these uncleared margin rules. So this is directly from the DTCC. There will be an upsurge in the volume of margin calls and an increase in the need for third-party custodians to keep safe collateral. The third-party custodian is essentially the middleman that is making sure both parties of these transactions are not messing with the process. So let's say there are 2 parties in a transaction, and since these are over-the-counter derivatives, meaning that these are not going through exchanges and the volume, in terms of the dollar amount of these trades are significant, the parties can get together, mess around with the requirements, and basically kick the can down the road. With these third-party custodians, you are no longer going to be allowed to do that. So when we're thinking about what is going on here, we know that there is going to be a significant uptick in these margin calls surrounding these OTC derivatives. Now, these OTC derivatives could be in the fixed income space, it could be in the option space, the future space. We don't necessarily know, but what we do know is that the derivative exposure of the top 4 commercial banks is upwards of 168 trillion at the current time. So let's break this proposed rule change down very briefly, or this proposed notice down. So basically what is happening is that all of these institutions know that the volume of margin calls are going to start going up. Now, this isn't necessarily the maintenance margin requirements, it's the initial margin requirements. So what they're looking at is, well, we're going to have to put a lot more money in initially in order to enter these trades, meaning they're not going to be able to get as over leveraged as before. That is healthy for our markets. But what they've been doing instead, according to this notice right here, is they've been using a lot of these 1 business day prior to maturity U.S. Treasuries. So the fact that we are now seeing the FICC remove this as a qualifying collateral, this just basically tightens the cinch down more on these institutions, and it is going to further accelerate this liquidity bleed that we have been looking for over the past couple of months and that we know is happening at the current time. So that is going to wrap up this update on AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button. So I hope you guys are having a great weekend, and I'll see you guys in the next video.